Hello and welcome. We are live from the trade desk. My name is Jeffrey Beamer. Today we're doing an update of our Deere and Company collar. This is a stock position that we have where we have collared the stock by buying puts and selling calls. And we are at a point now where we need to make a possible adjustment as we have earnings coming up in a couple of days. Now, this particular position is, we initiated it towards the end of July. We were near these pivot lows, and it was a good place to enter as this is an area that has been support, as you can see back here in May, maybe a slight resistance here in April, some resistance back in February, some support back here in December, which it ended up breaking through. But you can see that this area does have some support and resistance involved. And with earnings coming up, we just want to put ourselves in a position to first of all take advantage of any upside potential the stock may have, because our original target was back up towards the $84, $85 level where these pivots are, where these other highs were, and this one was actually up to 88. Or if the stock does drop, well, we're going to have our hedge. We have a put on this position already, and it could protect us if the stock begins to drop. So let's go ahead and take a look at our case study today. And you'll see that this is the original trade right here. And well, let's go through where we stand here. We originally bought 100 shares of Deere, and we bought a Deere, a DE, September 16, 72.50 put to hedge the position. And to help pay for that hedge, we sold to open a Deere September 82.50 call for about $1.30. And you'll notice here a little bit of credit there that help offset the cost of the insurance, and it did decrease slightly our overall cost basis in the position. Now here's where we stand. Again, we have earnings coming up in a couple of days. You'll notice here that the current bid-ask spread on this is 63 by 66. We could easily buy this position back for about 64 cents. And that way we are left with long stock and long put. Now that is called a synthetic call, which technically is a bullish trade, but it also is, it doesn't mean we're necessarily fully bullish on the stock. We do have protection to the downside. So let's make that adjustment and take a look at how that appears. So I've made this adjustment already here, and you'll be able to see kind of what has transpired. Again, we currently own the stock. We do still own the put, but these two positions here are the offsetting positions. We originally sold the 82.50 call for $1.30. We did buy it back for 64 cents. Now, for you guys doing your own case studies, we encourage you to do best efforts. The pricing might be a little different by the time that you see this update, but irregardless, we do have earnings coming up, and we just want to prepare ourselves for earnings. So let's go down to the risk graph and see what this means. All right, so now we've adjusted the position, and we are left with what appears to be a vertical, well, a call spread, not a spread, but just a long call position. All right, this is the same risk graph as a long call. But this is a synthetic call because we own stock and we own put. Now we're in a position to take advantage of any upside movement, or if earnings are poor and we drop, we are hedged down here at our long put position, which is 72.50. Below that level, our losses will cease. So this is our case study update for today. After earnings, we are going to make probably an adjustment here. If the stock drops, there's a chance that we will roll our position, we will roll our hedge, we will take profits in that put and possibly roll that down, maybe out. Or if the stock moves up, we may be in a position to sell a call into that move. All right, so we'll see what happens. Be prepared for an update after the earnings announcement here in a couple of days. But this is our case study update for today. I hope you found this of interest. Thanks for listening. We'll talk to you soon here from the Trade Desk. Have a good day.